Today, folks, by popular demand, we are diving down into Medical Properties Trust, a real estate investment trust that has made my buy list for that juicy dividend, that passive income for today. And this came from a question in my last video where a lot of you with an overwhelming response said, yes, do a review on this company. But first, you had some other questions as well. So let's start with doing some comments of the day here, folks. Taking a quick zoom out on the video, we have the first question coming from Ivan's Bikes, BMWs. I don't know how you bikes BMWs, but do you think it is a good idea to be buying a bit more of TD Bank stock since it just dipped? Well, TD guys, I've been buying the banks. I loaded up on them last year, picking up like literally almost 6+% yields on some of these suckers. And right now, honestly, TD's trading down, I think, from its all-time high here of about 6% or so, paying a 3.8% yield with a PE of about 10. Now, would I personally buy it here if I had absolutely no exposure? I'd pay fair value to start a position here, but these 3% yields don't get me attractive because Canadian banks are legendary for continuing to increase these already high dividends. So I would rather wait and try and catch TD over a 4% yield, or just perhaps take a look at some of the other banks and just see how they're performing. Not a financial advisor. For me personally, if I was new to this, like I said, I'd start a position, maybe cost in over time, but that's how I feel about TD. And if you want some historical information, I always just take a look at the dividend yield here, because we can see going through the pandemic here in 2020, the average yield was like 4.5% to 5%. And then going back even farther, the average yield was between 3.4% and 3.8%. So right now, actually, historically, we might be on the upper end of that dividend yield. So it's a fair value here, in my humble opinion. Leading into the second comment of the day, we'll get through real quick, comes from Truth Be Told. And he says, what you said about AQN is really stupid. They are going to dilute shareholders by another $1 billion. They also regularly dilute shareholders. They have a huge debt load, and they also have to borrow money to pay their dividends. I would love to know, because you want to stir the pot clearly here. You want to cause some problems with me. You want to have an intellectual fisticuffs over the companies and due diligence we've done on these, because I think a lot of what you're saying is truly wrong. And let me explain to you why. First of all, if you don't know AQN, it's Algonquin Power Corp. It is a renewable natural gas and even transmission line utility here with a 4.41 starting percent dividend yield. A really great return over 5 years, up 54%, not including the dividends or the increases, with a really healthy starting PE ratio. And let me just address some of his concerns. They do not pay the dividend with debt. So anytime you see a payout ratio on a company over 100%, that means they usually don't have enough money to cover the dividend. However, if you're looking at real estate or utilities, these industries are famous for doing write-downs, amortization costs, which are basically them writing down the equipment they bought, like owning a car that degrades and writing it down, but you're not actually paying that money out. So just to give you a quick idea on the actual adjusted net earnings, they were 64 cents per share, and the dividend paid out for 2020 was 61 cents. So they are paying out a vast, huge percentage of their income in dividends. And we can see even on the most recent quarter here, guys, the adjusted net earnings was 20 cents a share, and the quarterly dividend was 16 cents coming from March 31st, that 3-month end for 2021. So this company is not using debt to pay their dividend. They have enough income to cover it. Just going into their assets, minusing their liabilities. Again, this is based on Yahoo Finance 2020 data, a little bit older here. I do have the more recent data, but just to keep this real simple, the total assets sit at $13.2 billion, minusing the total liability of $7.5 billion. They're actually relatively robust with about 60% leverage here, which is actually really reasonable for the utility sector. And considering the quarter over quarter, they have been experiencing revenue growth. And just like TELUS Communications, most REITs, even the REIT we are about to look at, they even do share dilution. Because if we take a look at the actual common stock, guys, we can see that they've been diluting year over year over year. But there's only two ways a company can go about this, because if they want to continue to scale the dividend, if they want to continue to add assets and, actual fundamental value to the balance sheet, they have two options: raise debt and buy more assets, or basically raise capital from diluting shareholders and reinvesting that. When you dilute the shareholders, however, you don't put any debt on the balance sheet, and it allows you to retain some of that income and make things a little bit more robust. This company, I think the management's done an incredible job over the long term. They can afford the dividend. They're not using debt to pay it. They've got a great asset to debt ratio. So I don't know where he's coming up with that they're heavily debted, no more than any other regulated utility. So I still love this one. I think you're wrong on most of the stuff you're saying. So Medical Properties Trust. Let's get into this. Trades under the ticker symbol MPW. This is a U.S. globally diversified REIT paying a 5.29% dividend yield, a PE starting at 22, and has literally been flatlining since the pandemic has taken place. It's trading down 12.8%. So if you bought it at those highs, you've been holding flat for capital growth as of the moment. And taking a look at the dividend real quick before we get deep down into this, the yield has actually been decreasing. This has not had an average yield, even though they've been increasing it, which is technically a good sign because it means that the company's doing such a great job bringing investors in and making the balance sheet look robust that a lot of people continue to buy it even at these valuations, continually lowering the average yield, which is a little frustrating because most of us would rather get over at least a 5%. And this isn't a monthly paying REIT, by the way, it's quarterly. One of the reasons I didn't initially buy it, but sometimes you have to overlook those monthly payments to get something that's going to actually be super reliable long term. And taking a look at something that I find real fascinating in their statistics here is this company has actually been has had quarter revenue growth year over year of 24%. 24% year-over-year revenue growth is absolutely obscure for a REIT. I find it very unusual, so that's very fascinating. And just like we were talking about with amortization costs, we can see the payout ratio is 115.9%, but I'm going to show you why they're not using debt to pay that. But nonetheless, let's just take it one step farther here, folks, and just get right down into their most recent filings with a total asset of $18 billion, minusing the total current liability of $10.6 billion. A little over half leveraged. Actually, I think they're more leveraged than even Algonquin Power, maybe just slightly. So just check this out. The real estate depreciation and amortization costs were $75 million. That's insane. And if we scroll down, we can see that the dividend declared was 28 cents, yet the net income attributed to Medical Properties Trust common shareholders 28 cents. So they are literally paying out just as much money as they're making. However, those amortization costs don't reflect money paid out of pocket. So if you were to minus that 75 million, the company actually retained a lot of capital. I mean, this is like one of the most confusing things when it comes to real estate investment trusts. And go to the balance sheet and just take a look at the shares issued here, folks. Yes, we can see year over year another company that is diluting shareholders, but doing it really successfully because, again, this is what a lot of companies do rather than, loading the balance sheet up with debt. And I hope I'm not boring you here, but let's continue to take this a little farther. Let's get into Medical Properties Trust and take a look at this diverse portfolio. So just getting right into this, folks, apparently $20.9 billion total portfolio, not updated because on their June filing, they had a total gross assets of $21.4 billion. So even still growing quarter over quarter based on these most recent reports, which we're going to get a little more into, but just to generalize, 425 facilities, 9 countries, guys, and 44,000 licensed beds. We have general acute care hospitals making up 72%, which is basically non-major injuries, short stay, something like if you just wanted to go in for a quick checkup, something like that. And they have inpatient rehabilitation hospitals, behavioral health facilities, long-term acute care hospitals, freestanding ER and urgent care facilities, and other. And just taking a look at the total portfolio, the general and acute. So again, 4 surgeries, acute medical conditions or injuries, usually short-term stay, 201 facilities there for recovery and intensive rehab, 112 facilities, behavioral health facilities, 40, and then long-term acute, 20. And then finally, freestanding and urgent care sit at about 52 facilities. And if we take a look across country diversification, the US makes up 57.6%. And this is actually a really helpful thing to US citizens because I'll give you a little bit of a tax loophole here. Any REIT that operates more than half of their income in that given country usually sustain discounts on the actual income of the dividend because coming from a Canadian perspective here, if I buy a US REIT, I'm slapped with a 15% withholding tax, whereas in Canada, they give you tax benefits for buying Canadian companies that operate more than half of their company within the country. So I'm presuming that's why they keep it at that standpoint. But we can see 22.4% United Kingdom, 6.3% Germany, 6% Switzerland, 4% Australia. Very, very well diversified in things that matter. I mean, obviously, guys, hospitals are not going anywhere. So just taking a look, it's the second largest in the world, by the way, for a non-government owned hospital. So just a massive, massive REIT. And what I love absolutely most about this, guys, is the structure of the leases and the terms they have. So they have actually just recently renewed a lot of their leases at these record low interest rates. But what they've went ahead and done is they have inflation protected leases. So basically, as inflation rises, they have it baked into the leases to increase the annual rents year over year, which also allows to offer a much more stable dividend and allows some increases in the dividend as it all just gets calculated in. Materially, all such contracts include a minimum escalator averaging about 2% annually, and 75% CPI-based arrangements include inflation ceiling averages of approximately 4.5%. They've literally taken into account full inflation. Now, the craziest thing about this is one of the only REIT structures where I don't care about the properties. With something like a RioCan, my largest holding, I would actually need to know where those properties were, what I could expect out of them. With this guy, however, they're hospitals. It doesn't matter where they are. I mean, I have to use my local doctor, and I'm going to the physician. I don't know if they're renting that place or how they have the real estate set up for them. So, I mean, this is like just one of those few things you could plop anywhere, and there'll always be people that are needing to use it. And if you're looking for pure cash flow and you're not too worried about the equity growth or the equity dropping if real estate falls out, or if you think that we're going to head into another big problem, and if it's a health crisis like we're in, this company continues to benefit again and again and again. So I don't really care about the hospitals. They always have the most unique looking real estate, but it's not meant for tenants. It's meant for short-term stays and medical needs, right? And the coolest thing is just take a look at the quarter-over-quarter growth or year-over-year. Company's done a phenomenal job. In 2020, they hit record highs, obviously related to the pandemic, I would imagine. And quarter-over-quarter, they're still experiencing growth. Just a phenomenal job, guys. And like I said, the properties always look interesting. Don't care about that. First time I'll ever buy a REIT where I really don't care where the properties are situated. So at this point, I really want to pass the question off to you. What do you guys think about Medical Properties Trust? I could go much more in depth, but honestly, there's nothing better than a clean cut, dry balance sheet and a clean cut, dry company. However, I'm going to listen to some of the most recent conference calls and continue to go over some of the news here because they have been just dropping bombs. Like Medical Properties Trust invests $950 million in a behavioral health platform to continue diversifying here. Medical Property Trust acquires 5 acute hospitals in South Florida. Medical Properties Trust selected as one of the modern healthcare's best places to work in healthcare for 2021. I mean, it just goes on and on and on here, guys. This is just, I like this company a lot. I'm definitely going to be putting it on my buy list, and if it keeps going up, I might just buy it tomorrow. I need to stop making videos on things before I buy them. But hey, this just shows you that, you know, I care. I'm not just pump and dumping this stuff, guys. I do my best due diligence for you. So stay cool, stay awesome, and I look forward to catching you tomorrow.